Okay, I'm recording. So we have the one big beautiful bill that was executed into the law back in the summer this year. Have you all heard about this, or you kind of like still not sure what's going on with it?
I have heard it, but not from anyone that I would say is professional enough to be speaking upon it, nor do I know the intricate details of which it contains.
Got you. Anybody else?
Yeah, we all heard of it, but what's involved, we don't know.
I got you. Well, that's one thing we're going to do today. And let's think of it like this. We're all business owners. Do any of us like to pay taxes? I think the common answer will be no, I don't like to pay taxes. And this bill pretty much lowers your tax liability in many ways, whether people are W-2 income or if they're entrepreneur. And so in summary, what I'm going to do is I'll just share with you just some of the things that we see in the economic or political climate that's happened recently. So we know about the government shutdown. The government shutdown was triggered by this one big beautiful bill. And why is that? Because there's less income coming into the federal government. If there's less income coming into the federal government, what happens? The government have to balance their budget. If they don't have money coming in that's going to supply the revenue that can sustain, let's say, the SNAP benefit or the health insurance, healthcare, then there's reasons for that. And so the one big beautiful bill, which I'll get into, really helps the most people, the middle American, as it pertains to salary, save money in taxes. So that's really what we see. And then, let's say, for example, Kaiser is a nonprofit organization. Did you all know that? That Kaiser is a nonprofit
No,
organization?
no.
Nope.
So what happens is when you paid your insurance bill with Kaiser, some of you gave me a 1095-A. Because that's the only one that needs to be reported to the IRS. The 1095-A is all about the premium tax credit, and that premium tax credit is based on how much income that you made. And let's say, like for example, if your income was reported too high to receive the credit, and I did your taxes, which I've noticed this when I've done many of your taxes, you end up with a bill that may increase what you've already owed. And then, it's like, why do I owe more money? Well, because whatever you said when you completed the application for that insurance policy or that insurance plan, it was, when we did your taxes, it must have been more than what you reported. And I'm thinking as that you gave an estimate. So it backfires on you pretty much in tax season. Um, and so for me, it was more like, why even have this? If you're going to be penalized for having it, what's the point? But why not educate people to help them understand how to properly report their income so you wouldn't be hit during tax season? And I've seen people go from, let's say, $5,000 that they owe to over $10,000. And I'm like, what the heck did you say when you completed that form? So when you look at Kaiser, for example, and you see Kaiser has brought in over $6 billion from the federal government and from people that are insured that they're paying their premiums, Kaiser's making out pretty well. And so what this one big beautiful bill does is basically says, Kaiser, we're done doing business with you. We're going to limit how much we're paying you. And, then, you have this fight that comes across as politics that people are saying, oh, well, people are going to lose their insurance coverage. Well, we really need to be saying, Kaiser, you have made your money during the time that this Affordable Care Act has been in place. Now it's time to reduce your premiums because when the Affordable Care Act became law, Kaiser's prices or their premium went up. But that's because they got a good portion from the federal and they also got a good portion from those that were paying for their premium coverage. Does that make sense?
Not really. Like, cause probably because I don't have Kaiser, so how does that, because I know that happened to me one year when you did my taxes, and remember I ended up owing more after getting that tax credit. And I was asking you, like, well, what was the point of getting the tax credit if I had to turn around and pretty much pay the credit back?
Yeah, that's a good point. So what happens is, what's the point of the credit? I know. So what happens is they try to um, give people a benefit for the credit, meaning like part of your insurance is covered by the government, and then the other portion is covered by you. So the intention of the credit is that you may not see this on the front end, but on the back end, the federal government is covering part of your insurance policy. And because they're covering a portion of it, it is based on your income, right?
Hmm.
So if your income was more from, once we did your taxes, then that means that you got too much of the credit. But if you underreport it, then you did not have to pay any of that credit back.
So basically, it just matters when you fill out the form, and I'm assuming when you apply for insurance and you're giving them an estimate of your income.
Mm-hmm. Yep.
Okay. Okay. Well, which when you're a business owner, you really can only give an estimate because you don't
And
really
that's how they
know
get
what
you.
that number is.
Because you really don't know how you're going to perform in
Yeah.
business. And then when you get your taxes done, then it's like, oh, here's the evidence. So then that's how they get you, unfortunately.
Got it.
So that makes sense now.
Yeah.
So I think, I don't know what the government does or whatever, like their methodology, but if I was to make an assumption, I would assume that they're saying that we can see that this is not working and we're going to stop funding as much as we've been funding over the past years. And Kaiser needs to make the adjustment, or the insurance companies need to make the adjustment. Because when the Affordable Care Act became law, the smaller companies, so like when I switched from working for Deloitte, for example, so never, you still work at Deloitte, right?
Yeah, I still work at Deloitte.
So,
Can you hear me?
they can afford insurance because it's a lot of employees. But if you switch and go to a company that have less than 50, they were pretty much penalized and paying more money for insurance coverage and they couldn't afford it. Yeah, I can hear you. I can hear you, Nabri.
Okay.
So yeah, so it hurt the smaller companies. And that's where, for example, like with me, I was paying $2,000 a month for health insurance when I worked a job. And I was like, this is totally ridiculous. But just to give you an idea of what this one big beautiful bill is, it adjusts that particular uh coverage or that particular benefit. So they're basically saying we're not paying that much more money into Kaiser. We're done with that. Let's move on. And that's the same thing with SNAP benefits. So it works the same way. If you look at SNAP, for example, states were um, not properly estimating how much people were making to qualify for SNAP. So, in other words, some cases they were overstating their income. In other cases, they were understating their income. So, if they overstated their income, they received SNAP benefits, they perhaps were not qualified to receive it. And so, Maryland and DC have a high error rate. And so that's where that impacts why the government is not paying that much money into it. They're saying states, you're now responsible for paying more money into it. So that's one thing that one big beautiful bill addresses. So I'm going to share my screen with you and walk through some key points about this bill. And anytime you all have questions, feel free to stop me. And I'll share this with you all. So I'll send you a copy of it. I just want to make sure I kind of go over it during this meeting first. And then if I need to make changes, I'll just make some updates to it and then send it out. But I'll send this to you as a point of reference. Now, it might bore you, but ultimately you can have it as a point of reference. So some key takeaways here. We're going to talk about the 100% bonus depreciation, which is permanently restored for qualifying assets. We'll talk about the Section 199A qualified business income deduction, which is now permanent. Some people don't know about the research and development expenses, but we'll cover a little bit of that. But most business owners don't qualify for that. The SALT deduction cap, this is something that is going to be beneficial to the W-2 earner as well as the business owner. This business interest deduction limitation won't really be something that you all qualify for, but I'll just cover it just from a high level perspective, just so you can understand it. And also we'll cover some year-end planning opportunities, which we need to cover before December 31st gets here. So the qualified business income deduction, most people don't realize that this was going to expire. And what happened is this one big beautiful bill implements it where it doesn't expires. So it was set to expire after this year. What happens is your net profit is basically there's a deduction for that. So that's the deduction amount, 20% of the qualified business income. And most people don't see that really because you're not thinking, oh, I'm saving money. But this saves people like $2 to maybe over $10,000 of income being reported on their tax return. If this would have expired, you would have paid more money in taxes. You haven't, so let me ask this question because I think this is something that just to take into consideration. How many of y'all have been in business before 2015 or 2016? If you've been in business before 2016, let me know.
Yeah.
So Nicole, you might have seen this where you've seen an adjustment with your income or with your taxes because before 2017, this qualified business income deduction wasn't in place. Basically, you would pay more money if this QBI wasn't something that we take into consideration.
Mhm.
So with QBI, most people that started their business during COVID, they never realized that they could be paying more money in taxes. So it was set to expire, but now it's not expiring. Any questions about the QBI? Again, I didn't want to go into too much details of how to calculate it, but just educating you about what it is and that most of you qualify for it anyway, especially if you have a net profit. So here's one, bonus depreciation. Most people that really enjoy the bonus depreciation are real estate investors, as well as people that buy big purchase or have big purchases like a vehicle. So this bonus depreciation had started declining over the past few years. And what happened is this bill puts it back in place where it's 100% depreciation and it says permanent restoration. So this is applicable for anyone that is purchasing equipment or qualifying asset as of January 20th, 2025. If it was purchased before January 20th, it's 40%. but anything purchased as of January 20th this year will receive 100% bonus depreciation. So the qualifying property, this is tangible property with this MACRS, which is the type of depreciation schedule that we use, recovery period of 20 years or less. That can include computer software, qualified improvement property. So that's where people that have real estate investments that they can write off interior improvements. New or used properties, if used, it must meet original use requirements. Some of this, we may have to have a separate meeting to discuss it if you're looking at purchasing a property and you're like, Don, I want to make sure that this fits the qualifications. So we can definitely look at that. So when we look at year in action items, so what this means to you, assets purchased and placed in service in 2025 can be fully expensed in the year of purchase. So in other words, many times people think that just because you buy a property or buy an asset, you can just write it off 100%. That's not the case if it's necessary that we take depreciation on it. Most often people are not making those big purchases. It's very seldom. So if I have a client that is buying something like a vehicle or a computer or office equipment, it may qualify. And we talk about that as it relates to depreciation. And this gives an example. A manufacturing business planning to purchase $200,000 in equipment in early 2026 could accelerate the purchase to 2025 and deduct the entire $200,000 in 2025. And you can see potentially saving $40,000 to $74,000 in federal taxes, depending on the tax bracket, of course. So again, as you can see here, business owners are really set to save money in taxes. This next section, section 3, is about the section 179 expensing increase limits. So this expensing limit provides an alternative to the bonus depreciation. And these maximum amounts are pretty extensive. So what this means for you, section 179 allows immediate expensing of qualifying property, but with limitations. It works best for smaller businesses that don't exceed the phase out threshold. And you all do not exceed that. Now, I'll be glad if you did. Let me know if you're somewhere up in that range of expenses. But the planning tip here, use section 179 strategically in combination with bonus depreciation to manage taxable income levels. So if you have something that you need to depreciate and it's a section 179 asset, that's something we'll take a look at. So again, if you're planning on purchasing assets before the end of the year or even beyond this year, you let me know so we can see how we need to depreciate it. Research and development expenses. Now, some people think that this is about, I'm doing research, I should be able to write this off. No, it's pertaining to if you, let's say you're creating an app and you're like, Donald, I'm creating an app. Let's use your business. Many of you have business here. So let's say real estate. I'm creating an app for real estate agents, or I'm creating an app for my clients to be able to utilize this to best search for properties. Or perhaps maybe you're creating an app for the line of business that you're in specifically, and you want your clients to be able to utilize it to best use your services or schedule meetings or whatever the case is. You're paying somebody to help you with this process to create this app. I'll use one for finance, for example. Let's say, like, for example, if I wanted to create an app that will help you to best manage your personal finances, and I call this app the Butler Squared app or the Butler Squared Finance app. And, whatever I did, whatever expenses I paid for to create this app, I can write it off if it was done by domestic contractors or employees. Those that are based in the U.S., So anything that I'm doing that is in the US, if it's expenses covered in the US, I can write it off to produce that app. Are there any questions so far? I'll keep going. So this next section, section 5, is about the business interest deduction. I would say this is probably one of the areas that a lot of entrepreneurs miss out. And this is one reason why I would always say get a business credit card instead of using a personal credit card, a business loan, because you can write off the interest that you're paying on those loans or those credit cards. So this is all this is talking about. So business interest income is basically, so like, let me go back. So it restores the more favorable business interest deduction rules, which basically like, let's say like if you want to see how much your business is worth, we would put that interest back in your business and say that you technically made, let's say if you made $200,000, but with this interest deduction, this will put the whatever you paid in interest would apply it into that 200,000 that would say your business actually made, let's say 230,000 because you paid $30,000 in interest. So this helps you to look good on paper if you were trying to get funded or some other reason. So this is what this is all about. And again, most people don't pay any attention to that, but that's something you definitely should keep in mind when we do your taxes is if you have a business credit card or a business loan, make sure that we have that as part of your books. Section 6, now this is where we have fun with the W-2 earners. State and local tax deduction. Many of my clients, including you all, have paid over $10,000 in state and local tax. And what happens is when you pay $10,000 or more and you pay property tax because you own a home, you were capped at 10,000. It didn't matter if you paid 50,000, you could only write off up to $10,000. So this would appear on your W-2, for example, showing that you paid the state of Maryland, DC, Virginia, wherever you live locally, that you paid that tax on your W-2. So now the cap is at 40,000. Any questions?
I'm sure I do, Donald, but I can't quite put my hand around it right now, but I'm trying to make sure. So obviously this is a tax advantage for property owners and W-2 earners, right? So,
Definitely, yeah.
okay, I'm gonna need you to, I'm sitting in the back, so I'm gonna need you to talk a little slower for the people in the back to just reiterate this one more time for me.
I'm gonna
Please.
show you this on a so let's say someone says, Donald cannot itemize, meaning if you just have a W-2 income job and you're trying to itemize your deductions, right? You all don't really see this unless you pay attention to your Schedule A. But
Mhm.
if you give me your W-2, let's say on your W-2, you paid, I don't know, Mary Filing Joint, you have two incomes coming in. So that state and local tax is more than likely going to be somewhere near 10,000. So I'm going to put this as 11,000. Okay.
Okay.
So this is only if you're itemizing. And when I say only if you're itemizing, most people are trying to figure out if they can itemize. And what this bill does, it makes us answer this question a little bit different. Because at first I could say, well, no, you don't have enough. And your taxes that you pay to the state is capped at 10,000. We can't write any more off, so then you can't itemize. But now with that being increased to 40,000, it gives you a better advantage or a better chance to be able to itemize. So if this is 11,000, you also have property taxes. And that could be, let's say, 5,000. So now you can write off 16,000. Where at first, no matter how much you paid here, it would have stayed at 10,000.
I see, because they increased the limit to 40,000. Now we can take advantage of being able to take off more if we paid out more.
Correct.
So, okay.
So when you add your mortgage interest in here, let's say you paid 15,000 in mortgage interest and you gave away 5,000 in charity, you can write all of these off, and this could equal out to be more than what your standard deduction is for your tax filing. Let's say married filing joint or single, head of household, whatever it is. This provides that opportunity to revisit the conversation about itemizing those deductions.
Okay, great.
Because in many times I had a hard no.
Right.
No, you just don't have enough. And I would say, man, you paid all this money out in taxes and we can't even write it off. But now you can write it off because most of us are not paying more than 40,000 in state and local taxes plus property taxes. So this gives you the opportunity to really write off everything that you're paying to the state.
Excellent. Okay. Thank you for breaking that down for me.
You're welcome. That's my goal, is to break it down enough for us all to understand it, because taxes is complex,
Hey,
to
Donald.
say the least. What's that, Nevery?
Hey, just curious, when you say state and local, does that include like the sales tax that we pay to the county?
Sales tax is different. So no, not
Okay.
sales tax.
Okay.
This is what you're paying on your W-2.
Okay, just the W-2 stuff. Okay, I got it.
Yeah. But you as a business owner can write off sales tax. If you're paying through your business, put it like that. I won't even really cover this qualified business, small business stock, enhanced benefits, but I'll just give you the overview of this. This basically, this part of the bill expands the QSBS, which is the qualified small business stock. And this is effective acquired after July 4th, 2025. What this means is C Corp owners may be able to exclude up to $15 million of capital gains from federal income tax when selling qualified small business stock. And again, most of us here don't have stock to sell, but I just wanted to cover that just to give you an idea what that is. Number 8, individual tax provisions affecting business owners. Standard deduction increases. Every year, this increases. Let's say, again, we had that topic about if you could itemize. I'll use single, for example. Single, married, filing separate. Again, to me, they're not leaving anyone out. Because if you marry filing separate, and those clients that will ask me the question, can I file separate and itemize? Of course, both couples have to itemize if they're filing separate. However, with that increase of that state and local taxes, so state and local, I was thinking SALT before I said it, I was getting tongue-tied. But state and local taxes, with that being expanded, you can now have that discussion if it's best to itemize or if you cannot itemize. So yeah, so that's something that we can talk about. But these numbers basically says if I paid more in state and local taxes, property tax, mortgage interest, donations, and it's greater than these numbers, whatever my filing status is, then I can itemize. Does that make sense? Let
Yes.
me know if you have a question. Now, these standard deduction amounts, I would say since 2017, increased significantly. And that was again under Trump's tax plan. What happened is these amounts were beneficial, especially for people that could not write off deductions, meaning interest on mortgage, if they didn't have a mortgage, if they didn't have property tax, this would be something that they can take advantage of because these were higher numbers before 2017. So once 2017 came in, the standard deduction amount increased significantly. It's pretty much doubled. But it also caused people not to be able to write off anything. But now with the cap being removed or increased to 40,000 for state and local taxes, that's why I said now we can have that conversation to see. Well, I always had the conversation, but I'm just saying revisit that conversation to see if you can qualify for the standard, to itemize versus a standard deduction. So you may make out better with the SALT state and local taxes. They always increase the child tax credit each year typically. So it increased to 2,500 per child for tax years 2025 through 2028. Also, there's a $1,700 refundable portion, and the phase out begins at $200,000 if you're filing head of household, and also $400,000 if you're filing joint. There's no tax on tips and overtime payments or payroll. Let's say if you're working, or your children working a job and they're working overtime or they're getting tips because they work in a restaurant, it would be tip free or tax free. Tip free. No, tax free. Overtime wages and tips are tax free with special employer designation requirements. So employers must designate overtime on a certain form. Because I noticed our kids are paying more money in taxes, which is crazy. So most of us have decided what type of structure to have for our business. And, I just wanted to highlight this in this presentation. So entity structure considerations. S corporations, which is some of the advantages here, permanent 20% QBI deduction, which we already talked about, avoidance of self-employment tax on distributions, and 100% bonus depreciation for capital investments. And they're the main points here that I'll say that's pretty common. C corporations, there are some of you that have C corporations. Not very many, but you can see here some advantages, but many people don't qualify for this because they don't have, let's say, the investment part of it or these shares, selling shares of stock, or they don't have research and development costs. However, they're still experiencing the benefit of being a C Corp because the C Corp is being taxed separate from their personal. And because they're higher income earners for their business, this works best for them. Schedule C. So this bill is putting less emphasis on the Schedule C, meaning that the IRS supposedly is not auditing as many Schedule Cs as they have in the past. They're targeting higher income earners, which is interesting. And let me make sure I understand. Do you all know the difference between the Schedule C, C Corp, S Corp, partnership? I think you all do because you're my clients. But if you're not sure, let me know if you have any questions. No questions? So year end planning strategies. Number one, accelerate capital asset purchases. So identify equipment, vehicles, computers, furniture, and machinery needed for 2026. And you want to make sure that you acquire the asset before the end of the year. Okay? Order it. If you need something, Black Friday is coming, get it on sale. But as you can see, you can write it off this year, 100% bonus depreciation.
Hey, Donald,
Yes, sir.
I'm sorry. One more question.
You
So
good?
about that, I know last year, I had bought a bunch of equipment and, like, I don't want to keep going like where I have so much stuff I purchased. I've already bought equipment this year as well, but I don't want to keep going. I think you can only go so many years that you like didn't like make a profit. And I know last year that was the thing. I had so much new purchase equipment that it kind of made me look like in the red. So like,
Well,
what are your thoughts
that's a
on it?
good point that you just made because depreciation is not technically taking a loss. You are, but you're not. If we put that depreciation back into your revenue, you're basically in the positive. So don't worry about depreciation causing you to be negative because it's not really you're not really expensing to be in a negative. That's just your depreciation.
All right, thanks.
You're welcome. Let's see. So we already talked about these particular things, but I just wanted to make sure you have them as some key points. I'm going to go over some specific action items before the end of this year. One that's not listed here, but it is, man, I can't think of I'll come back to it. But basically you can rent out your house 14 days out of the year to your business. And that particular law, I cannot think of the name of it for now, but if somebody can think of it, let me know what it is. But yeah, I'll tell you the name in a minute. But these are some action items that you can look at before the end of this year. So don't really pay attention to the dates on the left, but these are just some things you can consider. So calculate projected 2025 taxable income. That's something that you can definitely take a look at. Identify your capital assets needed for 2026 so we can accelerate the deduction. We can order equipment before the end of the year. See, for accounting purposes, it's all about when you got it, when you ordered it, when you put it in place. If it's not in place until next year, we can't write it off until next year. So we got to make those kind of decisions.
Donald,
Yes, ma'am.
on the August rule.
Augusta.
Augusta.
Yeah, thank you. That's exactly it. The Augusta rule allows you to rent your house out 14 days out of the calendar year, and you don't have to pay taxes that your money is coming from the business to cover that expense. So say for instance, if you rented your house to your business for $1,500, your business pays you $1,500. Your business pays you $1,500. And you're like, well, how did it do that? Well, you can just transfer the money, but just make sure I know that that's what it's for. You personally don't have to pay taxes on that 1,500, but it's an expense to the business. That's the Augusta rule, but it's limited to 14 days out of the calendar year. Okay, so you can do it. You can do that 14 days in the calendar year. And as we approach the end of the year, I always like to highlight that as something like you might be throwing a holiday party. Um, I don't care who you invite, just make it a business, event.
Also, content creation. If anybody does anything for social media, I'm thinking content creation might work
Yeah,
according to that too.
So
yes, absolutely.
is that 14 days for the whole year? Like if you're running your business out of that, that's not the same thing.
No, it's more
Okay.
so that you're actually renting your house to your business. And this works best for S corps,
Hmm.
C corps, and partnerships. So if it's set up as a C corp, S corp partnership, we can write it off on that
Hmm.
business return,
Okay.
meaning the expense. So whatever you're charging the business to rent your house, that can be an expense on the business return, which can then reduce your tax liability.
So 14 days out of the 365.
365, yeah.
Yeah, got it. Okay.
Hey, Donald, question. Does there need to be an agreement of some sort between the business and yourself that, in terms of paperwork? What paperwork is needed in order to document that?
That's a really good question. Yeah, because as an auditor, I would say if there's no documentation, there's nothing that exists to prove it. So you're right. You should document that exchange or that agreement. It doesn't have to be so formal, like notarized or anything, but basically an outline of the date, what occurred, what was the purpose for the meeting, what's the expense, how much you're charging. And if you need some guidance, if you're like, Donald, I want to make sure that this looks right, you can always um, share it with me so I can take a look at it.
And does there need to be an actual exchange, a visual exchange of money between the business and the and yourself?
It's more of a transfer, or you
Mhm.
can write a check from your business. So if you transfer the money, Zelle the money, as long as we can reflect it in the books for the business, that's all that matters.
Okay.
But you don't have to produce, like you personally don't have to produce an invoice to the business. But the invoice is technically like we talked about, like it could just be that agreement that you documented that particular transaction.
What if you use your business credit card? Could that work towards paying that expense, that rental expense?
You can use your business credit card, but the thing is, how is it being paid? Is it like, so again, are you invoicing your business? Because that could turn out to be income to you personally that you have to report.
Mhm. Mhm.
And we're trying to avoid that.
Right. Okay.
You might have said this already, but is there a cap to that per day price?
It is based on market value.
Okay.
So in other
So
words, you can
like
look
fair
at other,
rental value.
right. Yeah.
Okay. Sounds good.
The other thing I don't know if I touched on, but retirement. If you are looking at your retirement options, that's something that we can look at as well. But you have the option to putting money away in your retirement plans. That helps to reduce your tax liability is also, so that's something you can do. Let me see if I can pull that up. Okay, I'm gonna share my screen. Yeah, and this will be recorded. It is being recorded right now, and I'll share the recording. I'm actually going to post it on YouTube specifically for clients, not to be out there for everybody, the world to see it, but share specifically with those who signed up to be a part of this. So strategy for maximizing your retirement contribution. So solo 401k, your contribution limit is 69,000 plus 7,500 for age 50 and over. The deadline to contribute this is whenever the tax filing is due. And I put extended return deadline. So we'll have an exact date once the IRS gives those dates. SEP IRA, up to 25% of compensation, and your max is 69,000. There's also defined benefit plan, and that varies and it can exceed $200,000. Simple IRA, this is 16,500 plus an additional 3,500 for those age 50 and over, but must be established by October 1st. So this is something that you want to think about for next year. So you as a business owner can put money into your retirement, which is pretty good. So just as a
Question.
go ahead.
Is that something that you're able to do monthly for that retirement? Like, is it something that you can transfer from your business monthly?
You can. Yeah.
Okay.
And we can look at that for you. So we can talk about that.
Mhm.
The cap is just saying, for the whole year, that's how much you can put into it for the year. But you can put in monthly or however often that you establish the agreement with the retirement company. So as a recap for specifically, I want to say those that work a W-2 job, because how many of you have people or your work, like when I say have people, like your spouse work a W-2 or you may be working a W-2, how many of you are in that category?
I am.
Okay.
Yeah, me too.
Me too.
So this is something you can share with your spouse as well as yourself. You can use this as a point of reference. So for W-2 income employees, so tax rates stay lower. So the current lower tax brackets are kept in place for 2025. This means your federal taxes will not increase next year and your paycheck keeps more take-home pay. So instead of them taxing you more money, you know how sometimes your salary goes up and you're like, oh my God, I'm paying more money in taxes. Well, taxes are not going up at the same time you may be receiving an increase in salary. We've talked about the higher SALT deduction, which again, this increases up to $40,000. So this is very helpful to you. The mortgage interest deduction, more valuable because it also helps you to have a lower tax bill. Charity donations, your charitable donations, I should say. You should consider donating money to a charity because your itemized deductions can be very beneficial for your taxes. And I use an example here. Maria is a W-2 employee living in the state with income tax like Maryland, DC, Virginia. Before this bill, she could only deduct $10,000 of her state and property taxes combined. After this bill, she can deduct the full amount she pays plus mortgage interest and charitable giving, allowing her to itemize and save significantly more. So, in summary, I would say this one big beautiful bill puts less money in the federal government and helps you to keep more money in your pocket. While this is the case, I would say I strongly suggest get your personal finances in order. I say that even more from a perspective of the Social Security benefit, because in the next several years, Social Security is likely not going to exist. And that will impact, I believe, all of us before we even can qualify for Social Security. Let me know if you need me to repeat that.
Hey, Donald, I know this is something you probably don't have the answer to, but just in case you do. Now, with all this talk about Social Security going away and stuff like that, like all these years we've paid into it, like how are they going to handle what people have paid into it? Is it just thanks for your contribution, or is it going to be like some big tax write-off that they calculate to be kind of deduct your money back out of it?
They haven't made a decision on that yet. But my point of reference is not from the news. It's from the Congressional Budget Office. And now I can share the link if you all are interested. And specifically in here, I think if we search for Social Security, there's a whole document. So what I'm gonna do is I'm gonna actually get the link first to the site, and then I'll show you what this document says. Okay, I posted it in the chat. So this is basically a PowerPoint presentation about Social Security and the projection. It says the balance of the old age and survivors insurance trust fund, because that's what it is, declines to zero. That is the balance of the trust fund. If that is the balance of the trust fund is exhausted in fiscal year 2033, and the balance of the disability insurance trust fund declines to zero in 2060. And it basically says if the two trust funds were combined, the combined balance would be exhausted in fiscal year 2034, 9 years from now. In the first year, after the balances of the trust funds are exhausted, the amount of resources available to pay benefits will be 22% smaller than the amount of scheduled benefits. The shortfall will increase over time. So with that being said, we can see here there's challenges with Social Security. And what's the likelihood that it's going to be around after 2030, whatever that year is? Very unlikely. So what I see is that we have more money that we can leverage to put away and save for our future, because the government basically not doing it. In essence, the government took our money that we were paying into for our future, and well, I won't say it's wasted. The reason why I won't say it's wasted is because it paid our grandparents, our aunts and uncles. It also pays for people that are disabled. Um, it pays for a number of things. So it's just that there's not enough employees that are paying into this trust fund, because the money have to come from somewhere. There are more people that are entrepreneurs today than ever before. Where my grandparents worked in a factory for years, that was the common job. Now, 2025, going into 2026, there's more people that are venturing out as entrepreneurs. And even in school, what are they doing? They're teaching entrepreneurship. Does that make sense?
Yeah, it does.
Yeah. So in layman terms, the W-2 is very valuable to the government. Let's say like Maryland, for example, they have AstraZeneca coming into the area. What does that mean for the state of Maryland? This means that there's a large employer with a lot of money, a lot of employees, so a lot of opportunities for jobs. Those jobs, somebody's in the waiting room. Hold on a second. Those jobs are guaranteed income for the state. So the governor's happy because they can project approximately, based on salaries that are projected to be paid to employees, how much money will come to the state from their paycheck. So the more jobs, the more money going into the government. That's why the government get excited about increasing jobs, because they know with the increase in jobs, there's going to be more money coming to the government. That's as plain as it gets.
Which we needed because of all the opportunities that have been taken away from the state within the past year. We need all the employers that we can get, honestly, to a certain extent. Now, I worked for the R&D arm of AstraZeneca, which is Metamine, which was in Gaithersburg. So I hadn't heard that they were bringing AstraZeneca actually to the state. Seems as though that they operate globally. I think that's a huge benefit or win for the state of Maryland, especially in lieu of the fact that we've lost out on what was it, the FBI coming in.
Mhm.
Like we've had some major losses. So
Yeah.
a pharma company coming in, especially because now, just from the time that I worked there, they were generous in terms of their pay scale, which significantly helped boost Maryland from a state tax perspective. So
Yep. And that's why the governor's excited, because there's more money coming to the state. So yeah. And that's what's happening with Social Security. There's not enough jobs to cover the cost of disability as well as Social Security.
Why
So
don't
what
they
are we gonna
why don't they add more incentives to bring them? I mean, they're already giving these corporations so many tax breaks. Why don't they add more incentives to bring the jobs back instead of us having to have so many jobs outsourced overseas? That will bring more jobs back to us and allow us to continue to, even if we don't get it, like you said, our aunties and our grandparents or something, they'll still be able to benefit it instead of it, you said, zero depleting the account.
Well, it's not an easy answer to what you just asked, but I would say look at what's happening today. How many kids want to work a 9 to 5? Are you seeing something different? Are you seeing that kids are becoming entrepreneurs, working less or have less of an interest of working a 9 to 5 job?
I'm honestly just saying we spending a whole lot of money giving stuff away for free versus requiring people on these assistance programs to have to work. And I'm not against it, but because I'm on the inside, I see that they're wasting a lot of money. They're not requiring people to work. They're just giving away, paying full rent, for individuals that are fully capable of working. I mean, and I
It's
see it.
interesting you say that, because that's what happened with the SNAP benefits. Is that what you're referring to? Like, those benefits that people
Mm-hmm.
are,
The
yeah.
SNAP, the housing, because I'm on the housing side. Like I see you're fully capable to work, but yet they're paying for your entire rent. And you get to keep just having more kids and we just keep on paying for them.
But also minimum wage also hurts a lot of
That part too.
businesses.
Absolutely.
Yeah.
Yeah, minimum wage is
Yeah,
horrible.
when
It's
you're
horrible.
16 years old, bagging groceries at a grocery store and it's making $15 an hour. Like a lot of stores just can't afford to hire a bunch of people.
That's becoming the issue. More companies, so it costs to have employees.
Mm-hmm.
the cost of having an employee, let's say like because you are the business owners. So let's say you're running a corporation. You're trying to figure out, should I hire an employee or should I hire a contractor? The benefits of hiring an employee for the government is the fact that you're going to be making sure that their taxes get paid to the federal, to the state, especially, depending on what state people are in. I have clients in Florida, Texas, they don't pay state tax, but you're responsible for that. So you may have an employee you're paying $1,000 to, but payroll is going to be an additional 500 because you have to cover part of their Social Security and Medicare. So that question that you asked earlier about what happens to all the Social Security money that we've been paying, the companies are saying the same thing. We're paying another portion into Social Security as well for these employees. I guess that's gone down the drain. But companies can write off that expense. But the cost of having employees, companies have to eat the burden of covering employees. And don't talk about health insurance because that topic, it's very hard to have because if you're going to have insurance as a company, you have to follow the law. Like, I don't remember all the details, but you have to basically document that you offered it to all the employees and they have to physically turn it down.
Yeah, if you have 5 or more employees.
Yeah. So yeah, some of these requirements on small business owners, they have to follow the law just like as if they were a larger company, and it doesn't help the small entrepreneur. It really can break the finances of a small company. But to your point, John C., John C's into real estate as well, real estate investing. And so is Nicole. I think you still have a property, but
Yes.
Nicole's a hairstylist. So you all understand like
Right, right.
housing, renting is a whole nother topic. So when you have to, you seeing people that's getting away with not paying rent, for example, and you have to eat the cost of that expense, but they could have paid their rent because they have the income coming in, but they can curtail the system. This is what the federal government is concerned about. A lot of that is happening, and that's why they're saying we're not paying for it anymore, or we're reducing how much we're paying, but also providing less burden on the average taxpayer so you don't have to pay much money in taxes. It's a very complex conversation, but I hope that this really helps you understand how to plan for 2026 coming and how this tax bill impacts you personally, but also your business. I'll stop the recording, but we can still keep talking.